Hi, this is Truman. I like to understand how companies work, and today we are going to talk about Tesla. Tesla is one of the most popular consumer brands in the world, but do we all know how does Tesla make money? What products are growing the fastest at Tesla? How Tesla is investing for the future, and what are the top risks that Tesla faces? In this video clip, we're going to cover all of these areas. Now first, let's talk about what are the structural trends Tesla is riding. We all know that there is a big transition from traditional gasoline vehicles to electric vehicles. But do you know how much penetration does the electric vehicle have today? Oh, here, according to Tesla, is actually very, very low. Tesla's market share globally is less than 2%, and Tesla is the leading electric vehicle company in the world. And in total, all of the electric vehicles' penetration rate in terms of market share is less than 5%. So in the grand scheme of things are still moving in favor to electric vehicles, and the trend of electric vehicles gaining market share from traditional gasoline vehicles is going to continue to be the case, just because how low the penetration of electric vehicle today is. And as you can see here, Tesla's market share in the US and Canada is actually less than 2%, and in Europe it's just about 1.2–1.3%. And China has been growing very fast, but it's still around 1.2% level. So globally, Tesla's market share is less than 2%. And that just tells you how fast and how much room there is for Tesla to grow. And next, how is Tesla different from the traditional car companies? A lot of people still think Tesla is just a traditional car company, and cars are a very competitive industry. But as a matter of fact, if you look at all the numbers Tesla produces, it tells you something different. So for example, the gross profit margin at Tesla is 27%, whereas it's only 9% at Ford and 12% at General Motors, the two largest and the oldest car companies globally. And then if you look at net profit margin, Tesla's net profit margin is at 17%, Ford is at 5%, and General Motors is only at 9% net profit margin. And you naturally want to ask, what is the big difference? Why there is such big difference between different companies' different margins? Well, the answer lies around how Tesla is building the company. Tesla is treating these cars as software products, not just hardware products. Traditionally, cars at Ford and General Motors, they are considered as hardware products. They are just physical goods. Whereas Tesla's approach is treating these as consumer electronics. They're using the same methodologies of building a phone in building a car. And that's why Tesla is using more component approach, more modular approach, and putting more softwares into the products. And as we all know, software is traditionally a much higher margin business than hardware. And effectively, once you get a Tesla car, because it has constant software upgrades, you are willing to pay for a price premium for the electric vehicle cars of Tesla than other brands there are on the street. And of all the software products that Tesla builds into its cars, autonomous driving technology is one of the most important and long-term strategic assets that Tesla owns. And this slide from Tesla's investor presentation day sums it very nicely. How Tesla approaches building cars is not just building cars, it's actually building a whole ecosystem from solar panels to energy storage, to vehicles, to FSD, which stands for full self-driving, which is the autonomous technology that Tesla owns. And it's all connected with software. So you can see a lot of efforts going into building the cars as if it's treating the cars as a pure software business. And that is why Tesla is so different from traditional car companies, and that is why the margins are much higher. And with higher margins, obviously Tesla is able to reinvest profits back into R&D, back into bringing productions up to scales. And that is why Tesla is built as a completely different company in its DNA from traditional car companies. And this is another very insightful chart that tells you about different market share by different models. And as you can see here, the Model 3 has already been the best-selling cars globally in the premium segment. It's selling more than BMW, than Audi, and the Mercedes. So as a pretty young model, only 4 or 5 years old, it has been able to not just catch up, but also exceed other competitor brands. That in itself is a proof that Tesla's products are well received. So it's quite reasonable to say that Tesla is at least 3 years ahead of competition, just given how much it has invested and managed to successfully bring these technologies to markets, from autonomous driving to energy storage to battery cell technology. So you may ask how far ahead Tesla is against competition. So reasonably speaking, it should be around 3 years at least ahead of competition, just given how much Tesla has invested in these technologies, from autonomous driving to battery cell technology. And in the same price segment, Tesla almost has no competitors from the same EV companies. So it's still constantly getting market share from traditional gasoline car models. And the business model of a car company, as we know, is that you need to invest a lot in fixed costs, building plants, bringing in factory workers. So you need to spend a lot of fixed costs at the early stage. And then once the scale and the volume pick up, the average cost goes down. And this is exactly what happened at Tesla. It has invested a lot of money into building all these things up, but once Tesla nailed the technology and become able to bring productions up to scales, the average cost goes down, and there's a massive cost reduction around battery cells because of the scales and because of the advancements of technology owned by Tesla. And that is why you can see Tesla is able to ship cars faster and faster. Every quarter, Tesla is able to bring record volumes of deliveries. And in the last 4 to 5 years, every year, Tesla is able to, on average, increase its production by 70%. And then when volume goes up, the average cost goes down, and Tesla is able to sell cars at a cheaper price than previously. So that's why about 2-3 years ago, if you buy a Tesla car, you need to spend about $60,000, whereas now it only costs you $50,000. And that's not because Tesla is cutting price to gain market share, but that's because Tesla is able to cut prices. As you can see, its gross profit margin has been steadily increasing over the last couple of years. So that's a natural ideal stage you want to be at, which is you just take the benefits from that positive operational leverage. Higher volume, lower cost, lower price, but higher margins. And that trend doesn't stop there. Going forward, Tesla has pretty clear plans of cutting costs further. It plans to cut the battery cost by at least another 50%, and also its capex intensity by another 2/3. And all of this just means higher operating cash flow, higher free cash flow, and higher net profits. And another unique thing about Tesla is that it owns all its distribution channel. So rather than relying on third-party dealers to sell your cars to the end customers, Tesla does a lot of the sellings directly online, and it also has its own directly owned stores. So in this case, Tesla speaks directly with the end customers. They know what's going wrong. They know what is their demand. They know what is their requirement. And that just gives Tesla higher visibility into customer insights. And then to put things in perspective, Tesla, even though it's much more profitable than traditional car companies, but when it comes to the size of Tesla, it's only a quarter of the likes of Ford and General Motors. So every quarter, Tesla is only producing 250,000 cars, whereas for Ford, it's producing 1 million cars, and for General Motors, it's 1.3 million cars. So even though size-wise, Tesla is only a quarter of General Motors and Ford, but it's able to achieve much higher margins, almost 2 to 3 times the level of General Motors and Ford. So that just gives you how much room Tesla can grow and how much further room there is for further margin expansions at Tesla when it doubles or triples its production capacity. Now, speaking of what are the risks Tesla is facing, I think there are a couple to highlight. The first one is obviously key man risk. Now, similar to Apple, who relies a lot on Steve Jobs' insights and intelligence, Tesla is heavily reliant on Elon Musk. And you don't really want a company that only lives on the performances of one single person or the ideas of that one single person. But no one knows what's really going on inside Tesla when it comes to, is Elon Musk able to pass all his knowledge and all his ideas down to other senior management or other people inside the teams. But that is something Tesla seriously needs to solve and prepare for. So then Tesla is able to reduce the reliance on that one key person. And the second is obviously competition. Everyone is aware that electric vehicle is the future. A lot of the traditional car companies are going into making their own electric vehicles, but there is a big gap between where Tesla is versus competition. And the competition is actually playing catch up. And as you just saw, Ford and General Motors, their margins are not high. And in order to invest in a completely new way of producing cars, electric vehicles are just completely different from traditional cars. You need new factories, you need new everything, you need new people skills. And that is something these traditional car companies don't possess necessarily. So even though there is this competition risk going on, but personally I don't think that is a very serious one that can become a tangible risk that Tesla faces in the foreseeable future, just because how far ahead of the competition Tesla is at the moment. So that's our take and analysis on Tesla. Hope you like it. If you have any other companies you want us to cover, let us know in the comments. Thanks for watching.